Welcome to the Real Vision Daily Briefing. It's Monday, November 30th. I'm joined by our managing editor, Ed Harrison. Ed, how are you doing?
I'm doing well, Jack, and welcome back from Thanksgiving to you.
Yeah, I hope you had a good one. So on in the market today, it had a little bit of a bearish tone to it. The Dow was down almost a point. S&P down a half point just as we're closing now, and the NASDAQ relatively flat. So I'd say that it's a day that's an exit away from the rotation into value we've seen. Would you say that?
Yeah, I would. I think you and we were talking about this before. There are a lot of different themes that we can talk about. We're not going to talk about one big theme, but just sort of cut through the markets in terms of a lot of different things that are happening: Bitcoin, politics, rotation trade, et cetera. If I had to sum up the month of November, I would say, I just saw hitting the wires before we got on that the Dow closed down over 200 points, but it ended November up 12%. I mean, the markets in general were up the most that they've been up in 1 month since January 1987. So that's 33 years. And I think there are three themes associated with that. One is that we got a vaccine, or we got three vaccines. In fact, the Moderna vaccine came out today saying they were looking for FDA approval. We also had a relatively uneventful post-election. I mean, there were lawsuits. It's still ongoing, but I think it's not as chaotic as people perhaps thought it could be. And then finally, there's a lot of liquidity hitting the market, that we still, if you think back to a conversation I had with Michael Howell, we're still benefiting to a certain degree from central bank largesse. So those three things might be the three themes that are pushing forward this 12% rise in the Dow in the best month for markets since 1987.
Ed, it's interesting you talked about your interview with Michael Howell. He has a very bullish view on the liquidity that's coming into the market. I actually interviewed someone who's been on Real Vision before, Teddy Valley, who's got a very different view. His view is actually that the month of October, November, as well as the next 2 to 3 months going into February of next year are actually going to be very liquidity negative in that the amount of money that is being, the amount of bills and bonds that are being issued by the Treasury, which, they're issuing bonds and they're taking in money, that's actually going to exceed the amount of treasuries that the Fed is buying per month. So I want to sort of have this discussion with you about, Michael Howell sort of as compared to Teddy Valley's view. What are you seeing in that?
Yeah, it's almost somewhat, you could say, a monetarist sort of view. Michael Howell, he's saying that irrespective of the fundamentals, when you pump that much liquidity into the markets, when you look at asset prices writ large, that means not just stocks and bonds, but also we're talking about houses and other sorts of assets that he's looking at, that it causes a bidding up of those assets because that money goes somewhere and it gets parked in those assets. It's interesting. It's an interesting theory in the sense that, you suddenly have all this money that needs to be deployed, and it's not all going to sit in cash. It's going to go to assets. That's not really how I look at the markets myself. I'm still toying with the idea as a potential way to look at markets, but I generally look at markets in terms of the real economy and over a longer period of time having an impact on earnings, and those earnings therefore having an impact on earnings per share and prices. And so I believe that markets go up when earnings go up and when multiples expand, but when the economy contracts and you have a recession, then you get a double whammy of multiple contraction and earnings contraction. And that's really when you have to watch out for outcomes. And that's what we saw in March. And potentially we could see that again in the next couple of months.
Absolutely. Ed, it's interesting that you are a fundamentals guy focused on the earnings and that the market will react to that. I was born and raised a fundamentals person, but I've become a little bit of a flows guy. That's what working at Real Vision for a year will do to you. Listening to the likes of Mike Green. So I actually was Teddy Valley. He said it was net. The liquidity is going to be net negative, and he had this fantastic chart that we can put up of just how the QE issue minus the Treasury issuance is very correlated to the dollars, to the DXY year over year. So, but I wanted to sort of dig into that. So over the weekend, I was just like, which statistics is Teddy using? So I think I finally found them, and it's the net cash raised by the Treasury per month. So in the month of October, the Treasury issued 1.5 trillion of bonds, bills, notes, everything, and they retired in terms of the notes were taken out of supply, just about 1.5. So it's $62 billion of liquidity that was sucked out of the market. Now, for October, I think the Fed put more money in, but I think what Teddy is saying is that we're at a point where going forward, the dynamic is going to reverse, where the Fed is actually going to inject money, but the Treasury is going to suck up all of that liquidity and then some from the market. So I think it was released today. The Fed released their schedule of how much Treasury bills they're going to buy, bills, bonds, notes, everything, whole 9 yards, for up until December 11th. And it's like $2 billion here, $4 billion there. So the experts are estimating it's going to be about $80 billion. So if the Treasury raises a net cash amount of greater than $80 billion, then Teddy could be right. And then we could see liquidity coming out of the market. Now, I agree with you. It's not the entire story. There's also the earnings story. We are seeing some good news on there. But yeah, what do you make of that?
Well, yeah, I think it's all about the time frames, because obviously, if you're talking about a shorter term time frame, maybe that has some applicability, and that's the time frame that he's talking about. What I think of what he said that is interesting is the dollar implications, because you and I, we were talking about the dollar and the fact that I tweeted out earlier this morning that the dollar index hit a 52-week low, Euro index hit a 52-week high. I thought that was interesting because of what Teddy has to say does have implications for currencies. What was he making of the dollar? Where is that going to go under his scenario?
So he thinks that he's long-term bearish. Bearish, it's maybe a little bit of a dramatic word, but he does not have a good view of the risk reward of the dollar in the long term. For the next 2 to 3 months, he sees a tactical opportunity to go long the dollar because of this negative liquidity dynamic that markets are going to have, because there's going to be less money in the system that's going to increase the value of the dollar. So it's going to be pretty much a reversal of what we'd seen over the past 8 months, where the Fed has flooded liquidity into the market, and that has pushed the dollar down. Now, maybe I'm attributing too much cause to that. So Teddy is long-term bearish on the dollar, but he sees opportunity to be long the dollar 2 to 3 months. Conversely, he thinks that real rates are going to increase, and this is something I want to pick your brains on. And so, because real rates are going to increase, he thinks that makes Bitcoin and gold less attractive to hold. And when I say less attractive, I do mean less attractive, because he is a long-term bull on gold and Bitcoin. And like many who have been on Real Vision, including Raul, Teddy has been right on gold and Bitcoin, particularly Bitcoin. But he actually says that he's pumping the brakes a little bit. And the interview I filmed with him was filmed last week before the giant sell-off, and it's going to air tomorrow. So we've had a little bit of a topsy-turvy trade there. Did you see anything in the market for Bitcoin and gold? What are you seeing there?
Well, yeah, I saw that gold and silver had been selling off a bit. And, before the weekend happened, Bitcoin had been selling off, and now Bitcoin has rallied back. But, I'm looking at gold now at 1778.80, silver at 2269. So, those are not levels. Those are potential entry levels if you're a long-term bull, versus it's similar to the dollar. So the question is in terms of reversals, obviously, if the dollar goes higher, on the back of real rates going higher, then that's long-term negative for gold and silver, because at the end of the day, you get a real return that's higher, and you get no real return from holding gold. And so from a opportunity cost perspective, you're foregoing more opportunity by holding precious metals, and that's generally speaking considered to be negative for the precious metals. So if he's right, then that thesis makes sense. The problem I have with that thesis is, on the one hand, he's talking about the liquidity situation being tighter, but on the other hand, he's talking about real rates rising, which would suggest that the economy is actually doing well, that we're getting out of a negative environment, and that means that the longer end of the curve is going to steepen, and that's where the real rates going higher comes from. So those two, for me, they're at odds with one another, and I'd love to find out how he resolves that problem.
I think that he is a believer in, maybe not in the reopening, but in reopening stocks, because real rates are going to increase, and that is going to cause a economy of growth where things are growing again. That actually makes growth stocks less attractive, because when growth is essentially zero, you'll pay a ton for Zoom growing at a high price. But if the cruise liners are reopening and the economy as a whole is growing, you're not going to be willing to pay that. So, Ed, I'm someone who's I'm not necessarily new to this, but it's these ideas, are sort of like forming in my mind about the correlation between real rates and growth. And this is something, when I was interviewing Teddy, it was going through my mind. And you've been in the trenches of economics and finance for a long time. Can you explain to me and the viewers why, when real rates rise, that indicates that growth is on the up and up?
Yeah. So if real rates are rising, then that's because rates themselves are rising faster than the rate of inflation. So inflation might go up, or inflation expectations, but rates are going up more. And the reason that rates would go up more in real terms is because people are front running the Fed's operations. They believe that the Fed is going to be jacking up rates in the future. And so they're sending up those rates in anticipation of that rise. And the only reason that the Fed is going to be increasing rates is because the economy is doing better. So a flattening of the yield curve is usually a sign that rates are going to go down over time. A steepening of the yield curve says that rates are going to go up over time. If it's a real rate rise, meaning that rates are going up faster than the rate of inflation, it's because it can only be, generally speaking, because things are happening that are good for the economy, that's causing the Fed to step on the brakes. That is the interest rate lever, and that's, generally speaking, because the economy is doing well.
Absolutely. Okay, that does make sense. So nuts and bolts, the interview with Teddy Valley, it comes out tomorrow. Please check it out if you get a chance. Ed, is there anything, Ed, what else is on your radar?
Yeah, I mean, there's a ton. Let's start to tick off some of the boxes here. So we started out talking about three narratives. We said liquidity, we said the election, and we also said the reopening, i.e. vaccines. The counter narrative in terms of the vaccines is a short-term economic pain associated with a rising COVID count. We've talked about this a number of times, Ash and I in particular. And on our Friday forecast, while you were recovering from your turkey fest on Thursday, we were talking about the numbers being low. We said that we were basically going through an extended weekend. And if the numbers for the case counts and the death counts, they go up and they stay high during the weekdays, but then they fall before they come back up during the weekdays again. So during the weekends, that's when they fall. And that's because things aren't reported, people aren't going to be tested, et cetera. And this is exactly what we've seen. In fact, the number of deaths from COVID in the past day was 818. The 14-day change is only 26% there. Case counts, 136,000 14-day change only 8%. So those numbers are moderating. So that would make you think that things are on the up and up. But the reality is that we're going to see an acceleration there. Not only are we going to see an acceleration because those numbers are artificially low given the long weekend, but we're going to see an even greater acceleration going forward when all of the people who contracted the virus due to the movement that we saw during the Thanksgiving holiday, when those numbers start to come out, which will be within the next 3 weeks or so. The number that I'm looking at, actually, Jack, is the hospitalization rate, because interestingly, that never lies, because people are hospitalized at whatever rate they are, and that number is consistently going higher, at least at the same rate of increase, but slightly higher than it was before. 36%, 14-day change, 93,265 people hospitalized in the United States. And recently, we've seen a lot of stories that have come out that have suggested that we're almost to the point in many areas where there's a hospital overload. That is, to the point where the system can't take any more patients, that elective surgeries elective procedures have to be put off, et cetera. So we're almost to that point. I believe we'll get to that point perhaps in early to mid-December. And what that means is that we're going to have more rollbacks, more shutdowns, and growth rolling over more than we have before. And so I think that is what's causing people to take a bit of fright against the reopening. That is the vaccine trade. They think that before we get to the vaccine trade, there's still going to be some pain to be had. And I think that makes sense in pandemic sensitive stocks. That's your leisure, that's your hospitality stocks, and things of that nature.
That's interesting. Obviously, it's very sad, a real tragedy that hospitalizations continue to increase, and it looks not good at all in terms of what's around the corner. I want to ask you about how this is going to impact markets, because I know in your previous times that you've expressed your view on this, it's been all about lockdowns and how increased cases are going to depress economic behavior because they're going to cause governments to enact lockdowns, or actually, and now I'm just remembering that people are going to sort of by themselves be very cautious about how they act. So they're not going to book that flight. They're not going to book that hotel. What's your outlook on that going forward based on everything that you just said?
Yeah, so I think that I think that all of that's true. That is that people, they automatically make adjustments to their behavior based upon the level of danger that's associated with the pandemic, and that will slightly retard growth. Then at the same time, governments, they react to that and they increase their measures, and that retards growth even more. The most pernicious part of it is when you get an overload of the system, because that's just the rolling over of growth. That's just a retarding of growth. The real problem is when the system becomes so overloaded that you need to have shutdowns, lockdowns, not just slight rollbacks, but hardcore measures. And here's a quote from someone who runs in a hospital system. He said, once you go over the case cliff, this is the number of patients that you're dealing with who are hospitalized, where you have so many cases that you overwhelm the system. Basically, at that point, when you fall off the case cliff, you're going to see mortality rates go up substantially. I shudder to imagine what things might be like in 2 weeks. So this is what Michael Osterholm, who's the director of Center for Infectious Disease Research and Policy at the University of Minnesota, told the New York Times. What he's saying basically is that it's not just that mortality stays constant. When you go over the cliff, it shifts up. So if you have, say, a 1.9% mortality rate, it could go up to 2.5%, 3% suddenly overnight, because the whole system breaks down, and as a result of that, you get a massive increase, and that's the point at which you get these lockdowns, these shutdowns, and you also get the increase of consumer behavior negatively. And I think that what he's saying from there is that we are going to get to that point by mid-December. So he said this just recently. So 2 weeks from now, those numbers are going to be very high. And just to give you a sense, just from the number of people who have died, the week before we went into Thanksgiving, we had 2,200, 2,300 deaths in a single day on 3 different occasions. The highest that we've ever had in the United States was on April the 15th. That was 2,752. So we're already within striking distance of that number. And that's not including, an acceleration coming from Thanksgiving or the overload that he's talking about. So I think that you could see that the risks there are very high. And this is coming from someone who's dealing with infectious diseases. So I think that the risks are not just about rolling over of the economy, but actually, a substantial rolling over to the point where a double dip recession is very much a distinct possibility.
Interesting. Ed, I'm going to play devil's advocate here. Ed, so interesting you say that, but what about the vaccine? What about the vaccines, plural?
Yeah, I mean, when you think about this from a stock perspective, it's really a waiting game. That is that, you have the companies that are not going to be affected too much by this delay. And the vaccines are already going to be starting to be administered this month to those who need it, the frontline workers, older people, and then everyone over the due course. And so the economy is going to reopen in a much more broad way at some point in the middle of 2021, especially during the non-cold period of the year. So that's all bullish. Those companies, that's where you're seeing the rotation trade. But then you have 2 sets of companies to worry about. One is the stay-at-home stocks. Those are the Zooms that you were talking about. And the other are the ones that were really affected in March and potentially could be affected again and that have very poor balance sheets. We're talking about companies that potentially have gone into bankruptcy. A perfect example of a company that went into bankruptcy already is Hertz. Mm-hmm. A company like that could end up being liquidated as opposed to exiting bankruptcy in a neat way. Or a company that has a difficult balance sheet that didn't go into bankruptcy already could go into bankruptcy. And at the same time, on the other hand, you have the Zooms of the world where you have the rotation trade saying, okay, we don't need Zoom as much, so we're going to sell that off a little bit. There might be a rotation back into the likes of Zoom to a certain degree, as long as there's some degree of uncertainty associated with how deep this retrenchment could be. But remember, this is a totally different scenario than what we saw in March. The scenario that we're talking about is a defined period of time. We don't know how long that period of time is, but we know that it's defined because on the backside of that, there's a vaccine. Whereas in March, we had no idea that there would be a vaccine. We had no idea how long the pandemic would last, how difficult it would be, et cetera. So that was a completely different scenario. And that's why stocks sold off as aggressively as they did. Now we're talking about a much more limited situation, limited number of companies that are going to be on the hit list, and also a limited downside as a result of that.
Okay. So what does this mean for specific companies? I think you laid out the view of the rotation into value that we've had over the past month. The Russell 1000's had the best month ever. The Russell 2000's had the best month since 1979. All the stocks that have been surged up throughout this crisis have faltered throughout November as the energy stocks are up 30%, 40%. But I think actually the index for energy is up 30% in the U.S., which really is remarkable. So we have these 2 forces, as you say. Which do you think how do you think that these sort of forces will interplay, and how will that impact markets going forward? I feel like before you've been very objective, but what is your view?
Yeah, I think the momentum for that rotation has slowed somewhat. And so therefore, if you believe that rotation still presents a good opportunity, it might be the ability therefore to get into that trade at a better level. There are a lot of people who think that this is the beginning of a longer term revaluation of value over growth. And also, we're talking about cyclicality over non-cyclicality. You think about the bank stocks as an example. They're a perfect example of a cyclical trade that now represents a time to get into those places. But obviously, if there's going to be a hiccup in the economy and stocks are going to sell off, especially the ones that are more vulnerable to the cyclicality of the economy, then that presents a better opportunity to get in. So I think that this is a very time limited period, so there might be more opportunity to get in, but there's also more downside risk to the degree that you're wading into the deep end of the pool in the more speculative names that are out there.
Interesting. So it sounds like you think that there are a wide variety of outcomes, that the opportunity set and the sort of possible futures that are very spread apart from each other. So it kind of sounds like you think there's going to be a lot more volatility, realized volatility down the road. Would that be right?
Yeah, let me give you an example. It's not necessarily related to what we're talking about, but it's sort of how these things can tip over. We recently did a series on white collar criminality on the plus tier, and it was about how the SEC handles whistleblowers, and how white collar criminals get away with certain things. I think that we know that in the case of Nikola, there are people out there who have said that they're engaged in activities that are fraudulent, if you will. I don't know if you can call them that. Is that really a white collar type of activity? Perhaps, but we do know that they've admitted that that the electric vehicle company said its demo truck was actually just rolling down the hill. It wasn't actually powered by an electric vehicle, electric engine. So that's certainly something that's happened. And just today, as a result of all of the things that have come out there, GM has decided to pull back. They said they're not going to invest as much in the company. I think those are the kinds of things that in a market that is not as robust in terms of the underlying fundamentals of the economy, people start to second guess. They start looking at companies in terms of, are they doing what they said they're going to do? Are they actually as good as they said they were? And so I think Nikola, which was down something like 26% today, they're getting hit as a result of that. I think, by the way, it may be me overreaching on that, because you and we were talking about DoorDash on the other side of that. I mean, there's always a flip side on the coin. DoorDash is coming out with an IPO. I think that they are valuing the company at something like $30 billion. So that's a rich valuation for DoorDash. So I think that we're still in a period where it's still not clear, who's going to win out. We're still in that period where it's in flux how deep this particular re-rotation back into the stay-at-home stocks is going to be.
Absolutely. I think the DoorDash IPO, that valuation you mentioned, it sounds quite rich, and it may be justified. It may not be. I haven't gone through the numbers, but I will say this: when you order food on DoorDash, a guy comes on your door, he knocks on the door, and he gives you food. It's not demo food like the Nikola demo truck. He gives you real food.
And it's also a stay-at-home stock. So,
Absolutely.
At the same time, despite the rich valuation, it represents a certain trend. I mean, my takeaway, Jack, from all of this is that there are a lot of cross currents that are happening now, and it's not clear which ones are going to win out and which companies are best positioned to gain from this particular move. we've seen a massive rotation and a massive up move in the market in November. I don't think that it's necessarily going to play out the same way in December. It's going to be a different market.
Yeah, absolutely. And I think there's a lot of truth in the macro point you were saying earlier, which is that in a market that is just being flooded with liquidity, that is just every asset is swept up, and there isn't a lot of discernment. Investors are not sort of looking under the hood. Whereas when you have a period, perhaps like we're having now, I don't know, where things are a lot less certain, people are paying a lot more attention and are paying a lot more attention. The GM deal is funny, and all electric vehicles stocks have been swept up, not just over the past few years, not just since COVID, all that is true, but particularly even last week, you're getting a flood of capital going into, not just Tesla, but the Chinese automaker NIO, Workhorse as well. I know our producer Brian Caputo is a particular fan of that stock, and perhaps its options as well. But so that electric vehicle story is something that's very interesting. Obviously, the growth is there. Is it worth what people are paying for it? What do you think about that?
Yeah, I don't know. Actually, interesting you would say that, because I don't know if you know this. I did an interview with Howard Klein of RK Equity today at 2:00. That's going to come out on Thursday. That's a lithium story. He calls himself the lithium ion bull, and he's really looking upstream towards the mineral that's used in the batteries that are used in the cars, as opposed to the actual car company Tesla. Even though he says, obviously you could have gotten a 10-bagger out of Tesla, but he's still sticking with his story, and he's seen some upside there. So I think that there is some upside with the EV market, just from a purely secular perspective. It's not just in China, but it's also now increasingly in Europe, and soon to be the United States as the laggard of those three different areas. So yeah, EV is a big thing. And interestingly, on the flip side of that, I was looking at the Wall Street Journal. One of their marquee articles today was troubles in the oil patch, low prices to lost jobs, which is emblematic of sort of this rotation unwinding a little bit today, because energy shares were the ones that were getting hit the most. You had this article in the Wall Street Journal as the headline, but energy shares were up, as you said, in November a lot on the reopening trade. So again, there are a lot of cross currents here on the last day of November as we head into year end, where you're going to get some tax loss selling. People who want to lock in some of their losses and be able to offset their gains based upon that. So there are a lot of things that are going to be happening in this last month of the year.
Yeah, absolutely. What you said on the oil sector, I think Teddy Valley said that 2021 has perhaps the best supply-demand dynamics for oil that he's seen going back essentially to the beginning of equities, of oil equities being public, because no energy companies are spending on CapEx. They're restricting the cash. They're letting people go in order to avoid bankruptcy. As a result, they're not spending on CapEx. So that could be very bullish for oil in 2021. One last thing, Ed, before you go. You mentioned your interview. I'm sorry, what was his name again?
Howard Klein.
Howard Klein, very interesting. The lithium bull. I think that is a really interesting trade. I think electric vehicles are future, but electric vehicle stocks in terms of investing have just soared to the moon and then some. So I think it's kind of an interesting trade. The saying, when there's a gold rush, don't invest in a gold mine. Invest in the company that's selling the miners shovels on their way down. I think it's a very interesting trade because lithium is a very important input to electric vehicles. And if I can plug an interview of my own that I'm doing on Wednesday with James Litinsky, who's the CEO of MP Materials, which is the only rare earths mine in the U.S. 95% of all rare earths are mined and processed in China. So he really has a monopoly within the U.S. And that company was actually made public via a SPAC via none other than Chamath Palihapitiya, who, as you know, was interviewed on Real Vision. So yeah, I think that's an interesting trade, investing in the shovels rather than the gold mine.
And when's that coming out, by the way?
So I film it next Wednesday. I think it should air sometime in the following week.
Excellent. You know why? Because Howard talks about that company in particular, and he talks about SPACs in general. That's a space he says he's been in, I think, since 2004. So it's some very pointed commentary. I'll wait for it to come out so that you can take a look at it and see what he has to say. But very interesting, this whole how all of these things are coming together, because SPACs obviously aren't just for technology companies. They're for some of these companies that are doing the nuts and bolts, the nitty gritty, like MP Investments. I think that's a great. I'm really looking forward to seeing what he has to say.
Absolutely, and I'm looking forward to your interview with Howard Klein. Ed, thank you so much for joining me. Any last words for the Real Vision audience?
Yeah, I think the last thing I would say on the positive note is that when I was going through sort of the themes of the day, I was looking at Wall Street Journal had something on the Labor Department publishing flawed estimates of weekly jobless claims. This is what a watchdog, the General Accountability Office, said. And the interesting bit, I mean, just from a bullish perspective, is that what they said is that in the end, the majority of states have been paying pandemic unemployment assistance claimants the minimum allowable benefit instead of the amount that they're eligible due to their prior earnings. And that statement alone, that's what the GAO said, to me suggests that there might be some, even without new legislation, ability for people to get more money from the pandemic unemployment assistance that they're owed by states, maybe via the government, maybe via states, but it suggests that it's not all doom and gloom per se, that even though we've had a hit to incomes as a result of people falling off of those benefits and more people becoming unemployed, there might still be something positive in the pipeline. So a minor positive note in terms of a gloomy day.
Yes. Thank you, Ed, for that silver lining. And talk to you soon.
You bet.